I'm looking at question 3, TUT letter 4862. Right, so this is quite an interesting question. Discuss with full supporting reasons reference to relevant provisions the potential taxation consequences for the proposed transaction. So the proposed transaction here was the waiver of a loan. Did you guys pick that up? Okay. So what sections are you guys contemplating here? Okay, so these guys owe 125 million rand to these guys here. Right, so we've got Art and we've got RK. Okay, maybe let me start with Art. Do RK there. Okay, so in the books of RK, we have a creditor of 125 million, right? 100 is the loan amount and 25K is interest. Right, and this side here, we have a debtor, and that debtor, 125, 100K is the loan amount, and the 25K is your interest. Guys, comfortable with that? Okay. All right, so let me start with the ones that are writing off that debtor. Remember, when they write off their debtor from an accounting perspective, they will say credit the debtor, debit, an expense there. Okay, so bad debt. That's our starting point, right? Okay, I've got 3 types of deductions. General, it cannot be considered a general deduction. Think about why it cannot be a general deduction. Expenditure actually incurred in the year of assessment, in the production of income, but it is what? Capital in nature, so therefore that cannot be claimed as a general deduction. Does this make sense? Okay, so you can potentially get a mark for stating it's capital, no section 11A. All right, bad debts. Considering bad debts, is it due to the taxpayer? Yes. Was it included in taxable income? Was this amount ever included into taxable income? The 100K, never, because the journal entry was debit what? Debtor, credit what? Bank. However, the interest was debit debtor, credit what? Interest, which is in the income statement, which went into taxable income. So that was never included into taxable income. That was included into taxable income. Make sense? Right. Can you prove that it's bad? Yes, we can prove it's bad. The company is struggling. Okay. And number 4, in the current year. Yes, it happened in the current year. Therefore, 25,000 rand will be claimed as a Section 11I deduction. Simple, right? Okay, and then looking at the 100K, the 100K cannot qualify for your Section 11I deduction. Okay, so that cannot qualify for a Section 11I deduction, not included in your what? Taxable income. Are you guys comfortable with this? If it cannot qualify for your Section 11I, where do we go? Capital loss, right? Actually, there's also no Section 11A, because it is capital in nature. Right, so where do we go from there? We go to your proceeds equal to 0, base cost is equal to how much? 100K. So therefore, I have a capital loss of how much? 100K. Okay, if I have a capital loss of 100K with a connected party, what is the issue there? Ordinarily, I need to what? Disregard unless what happens? Unless you apply section what? Section 19 or paragraph 12A. So therefore, we need to first see if we'll apply section 19 or paragraph 12A. Does this make sense? Okay, so we're dealing with the connected party here, so we need to consider if we'll disregard. We will disregard unless section 19 applies. Okay, cool. Right, looking at this company here. Number one, we need a debt benefit. Is there debt benefit? Yes, 125K. Right? Does that arise from a debt? Yes or no? Yes. Only 100K of that arises from a debt. The other 25 arises from what? Interest. So therefore, this interest here, I will only consider it in terms of section 84A. Okay. Number three, is this a commercial transaction? Was it part of a donations tax, estate duty, or fringe benefit transaction? No. Commercial transaction to ensure that the subsidiary is not technically insolvent, right? Okay, so it is a commercial transaction. Number four, was this used to fund expenditure, trading stock, or an allowance asset? Or an allowance asset. Can you switch off? Okay. Yeah, I know. All right, so was it used to fund expenditure? Was it used to fund expenditure? Nope. Was it used to fund trading stock? Nope. Was it used to fund an allowance asset? No. We are told in the question that this amount was used to acquire a building, and that building you could not claim any capital allowances. So if you could not claim any capital allowances, what does it mean? Therefore, section 19 is not applicable. Does this make sense? Section 19 is not applicable. Comfortable? So if section 19 is not applicable, therefore we're going to go to paragraph 12, capital A. So looking at paragraph 12, capital A, again, it follows a similar process where we look at whether we have a what? Debt benefit. Do we have a debt benefit? Yes. Right? We do have a debt benefit. Number two, right? Was this a commercial transaction? Yes, it was a commercial transaction. It was not part of a donations tax, estate duty, or fringe benefit calculation. All right? And then we ask the next question, was it used to fund a capital asset? Was this used to fund a capital asset? Yes. So therefore, what we're going to do is take, right, our reduction amount, which is 100 million. Is it 100 million, right? Take your reduction amount. You subtract from that reduction amount your what? Base cost of your asset. What is the base cost of your non-depreciable asset? 100 million. So therefore, you reduce that base cost down to 0. So therefore, going forward, when you dispose of the asset, whenever you dispose of it, proceeds will equal to the selling price, base cost will equal to 0. Does that make sense? So when you sell it at a later stage, proceeds something, base cost 0. Okay, and that's how paragraph 12a applies. Just reduce the base cost of your asset. Is that cool? All right, and then your 10 million rand that you're going to recoup in terms of section 8.4a. If you think about it, previously you claimed what? 10 million rand as a deduction. Therefore, when it's written off, you add back into taxable income 10 million. So you cancel that and you cancel that. Can you see? You cancel that and you cancel that. Was it 25? Sorry, 25. It's 25 million. My bad, it was 25 million. Is that cool? And that was that question for 25 marks. Do you understand the principles around the 25 marks? Cool. That's why I chose to do it last. Yep. All right. We will disregard unless paragraph 12a applies. Paragraph 12a applies. Therefore, we're not disregarding that capital loss. So I will have asset 1, 2, minus 100 million, right? If ever there's any other capital gains that I have there, I can reduce my capital, my aggregate gains with that capital loss. Okay, so can you see I've concluded that side, then I can go and wrap up the other side. Any questions, guys? Okay, if you understand this, then you're good. You can do that question, then I think I've prepared you enough. Okay, if the capital loss is not utilized in the current year, carry forward that capital loss into the next year. Okay, so let's think about if there are any donations tax implications. Are there any donations tax implications? All right, so market value of your donation, 125 million rand. Any specific exemptions that you qualify for? Right, if you have my handwritten notes, do you have donations tax? Right, you will see that one of those specific exemptions is any transactions within group of companies. So that amount is exempt from donations tax, no donations tax payable. Okay, so if you run through that list of exemptions that I gave you, one of those is group of companies. Cool. If it's not a connected person, so then you're not going to ring fence this. The only time you ring fence this loss is if it's a connected person. If it's not a connected person, they will immediately claim that capital loss. On the donations tax part, if it's not a connected person, think about it. This is a commercial transaction, so it's not going to go to donations tax. Okay, part of group companies, but only if you're dealing with dormant companies. Yes, it has to be dormant companies. Did I exclude that? It has to be a dormant company. It's there. Okay. Cool. Sorry. So that is paragraph 56, 1, 2, and 3 of your 8th schedule. Okay, guys, if you look at my new notes, I did distribute them in this class, right? Test 1, second part, but I did put them up in the Google Classroom. I actually deal with disregarded losses there. test 1, type letter 105, handwritten notes for that. Okay, cool. Any questions? All good? All right, let's look at question number 3. I'll start with the 4862 test, then I'll go back and deal with the 4861 test. So I'll do 4862, then I'll do 4861. So 4862 is the last question in your pack there. Okay, question number 3, 4862. So this was the exam, or the test, sorry, for last year, 2018, test 2. Okay, so 32 marks was the first part of the question, 6 marks and 2 marks the second part of that paper. All right, and yeah, a lot of students, after the test, as usual, they complain, 32 marks, where are the 32 marks there? I have no clue where the 32 marks are. But guys, if you take it step by step, there are 32 marks there. Actually, more than 32 marks there. Make sense? So, don't panic. Do what you know. All right? And in doing what you know, do not shortcut. Do not get to the solution, to the answer quickly. All right? Do it step by step by step. Does that make sense? Okay. Right, the highest from this class obviously last year was 98% in that question, right? And then you had like the other guys that didn't get that grade. Does that make sense? But the difference between the two, step by step by step. Okay, so let's go through this. Don't rush. Take your time. The formulas that I've given you there, guys, will make you earn very, very good marks. So we've got a company and its fellow subsidiaries. So there's the creator at the top, and then there's bricks for all at the bottom there. Right, wholly owned, so 100%. Usually that relates to test 3. Manufacturer of bricks. So the manufacture of bricks is a process of manufacture. So we're considering, sorry, section 12C there. September year end. It's neither small business corporation or personal service provider. This is usually test 3 stuff. All amounts include VAT. So all amounts include VAT. You had to identify all your VAT implications. Make sense? All right. Then let's move on. Year of assessment we've already touched at. And then we've got your taxable income of 28,370,600. So that's your starting point. So this is a pure calculation question. 20 what? 28. 370. So on the 15th of August, they purchased 6 brand new apartments in a residential building. That comprises of 25. So multiply that by what? 55%. Part of, right? They purchased the apartments directly from a developer. What do we know about a developer? Developer will charge VAT. So therefore, the cost is 250 each. So I need to include in there what? The VAT. Okay. But now, what section am I contemplating using here? 3 types of sections I can deduct. General, specific, or prohibited. Specific, right? So I'm looking at residential accommodation here, and I'm looking at section 13.6. Guys, comfortable with that? When can I claim section 13.6? Number 1, can only claim it if we're looking at the cost of an asset, right? 2, I can only claim that if we're looking at more than or equal to how many units? 5 units. And I'm only looking at that if these are in the Republic. Make sense? Right? And a lot of you actually left that out. Or a lot of students left it out. Simple stuff. What is the cost of your asset? Cost of your asset will be the cost including VAT for your residential accommodation. Okay, so therefore that will be 250,000. Multiply that by 1.15, and that gives me the cost of my asset. What's that cost there? 250 times 1.15 gives me 285. 287,500. Okay, cool. Guys, comfortable with this? That's the cost of my asset. Now, I have determined my cost, right? Right? I already know that part of a building is times 55%, and I know there are two rates I can use, 5% or what? 10%, right? 5% if it's not a low cost, 10% if it's a low cost. What is a low cost? Less than 350K if it's an apartment, and less than what? 1% of the cost. So rent needs to be less than 1% of the cost. Make sense? Right? A lot of students, again, mentally did this, right? Just wrote down the calculation. Lose a lot of marks. Okay, guys, even if I don't state exactly what I'm doing, but I'm writing it down, so it takes away all that doubt from the examiner's mind. Make sense? So the examiner is not going to read the English, is going to read your thought process. Who cares whether I introduce that or not? Important thing is I've put it down. Make sense? Okay. So let's look at that 350. Two of the apartments are occupied by employees free of charge, whilst 4 are rented for 3,000. So 2 are free of charge. So rent is 0. 1%, rent is 0. 1% of the cost is 2,875. Right? So therefore 2 times 287,500, multiply that by 55%, multiply that by 10%, and that I will claim there. Make sense? And then we have 3,000 compared to 2,875, more than, so that's not low cost accommodation. 4 times 287,500, multiply that by 55%, multiply that by 5%. 7 marks easily you can get by doing that. Okay, bottom line is how many residential units do you have? 6 residential units. Of the 6 residential units, 2 are low cost, the other 4 are not low cost. And guys, your classification from low cost to non-low cost, it happens every year. So in one year it can be low cost, the other year it cannot be low cost. See, the challenge is you don't apportion that section. So I will determine that deduction at the end of the year. So if at the end of the year it's not low cost, I multiply that by 5%. If it's low cost, then I multiply it by 5%. So the act is not specific in terms of how to deal with it. So if it's not specific, you have to interpret it, and you interpret it in a way that reduces the tax benefit for the taxpayer. So if it's for the whole building, that disappears. 2 times 287 times 10%. Okay, so your 10% is claimed at 55%. So 55% of the 10%, to be precise. All right, are you guys comfortable with this? This was 7 marks in your test. Yeah. All right, so why are we including the VAT? Cost, right? Let's think about this. Cost is the cost of your asset excluding VAT, except 1, VAT denied, 2, exempt transactions, right? Okay, and this is an exempt transaction. So actually stating that this was an exempt transaction and including the VAT, there was another mark. Cool. Okay, so this was 7 marks. All right, look at the next one. The next one was, how many marks was this? No, it wasn't a big one. Okay, but point number 3 was about 14 marks. Okay, so defective bricks manufactured, included in the closing stock of 150 at year end, treated correctly in cost of sales, so no adjustment there, were donated to a local charity on the 10th of December. No Section A receipt was received, so that is going to be a recoupment at what? At market value, so I'll include 140,000 into taxable income. Guys, I will make a song and dance off this, so what will I claim? Marketing deduction of 140,000 rand. Okay, on the 31st of October, they purchased a brand new brick making machine. All right, so from a non-connected party for 480,000 rand, which is equal to the market value. In addition to the purchase price, they incurred transport cost of 7,600. Right, machine A was brought into the process of manufacture on the 1st of November 2018. On the 1st of June 2019, they purchased and brought into use a second-hand brick-making machine that was advertised from a non-connected party for 345,000 rand. Open market value was 460. Right, so they could not refuse the good deal, right? At the same time, they donated machine A. So machine A, which was purchased on the 31st of October, was therefore donated. Donated is a deemed what? Disposal at what? At market value. All right, decision was accordingly made by the directors to assist its fellow subsidiary and to donate that asset. On the 1st of June, the open market value was 598, so that's your proceeds, your selling price. Okay, we're allowed to write it off over 6 years. So I've got 2 assets here. Let me start with machine B. I want to start with machine B. So machine B was purchased second-hand. So obviously I know I need to multiply that by 20%. Cool. Right, I take the cost of my asset, multiply that by 20%, and that's my allowance. The cost of your asset is equal to lower of cost or market value. You guys remember this, right? Also included in the cost of your asset are all costs necessary to bring the asset to its present condition and location. All right, so obviously that will relate to the first asset there. So looking at this asset here, it was purchased from a non-connected party for 345,000 rand. All amounts are what? Inclusive of VAT. So therefore, I will say lower of cost. Cost is 345. times 100 over 115. So what is my cost in this scenario? My cost is 300,000. Market value of this asset is equal to 460, but I know market value includes what? That, right? Should I multiply this by 100 over 115? No, I'll take into account the actual VAT that I claimed, and the actual VAT that I claimed, therefore, is how much? 45,000 Rand. So therefore, my market value is 415,000 Rand. So therefore, lower of cost or market value is how much? 300,000. Multiply that by 20%, and that's how much I claim as a wear and tear allowance there. Come again? All right, so what's the logic of law of cost or market value? Anti-avoidance, right? So A limited sells to B limited, connected or unconnected, right? Market value, that's why I'm saying connected or unconnected, doesn't matter. Market value of this asset, 100 Rand. Cost of this asset, 100 million Rand. Why are you selling it for 100 million Rand? 100 million Rand, multiply that by 40%, and you'll immediately reduce your taxable income by 40 million Rand on an asset which has a cost of, which has a market value, sorry, of 100 Rand. So this was to avoid manipulation, where people manipulated the system. This was a court case, right, where someone actually did this. All right, so therefore the act was amended to say law of cost or market value. Yes, it happened. It did happen. Yes, they were connected parties. That's why, either way, connected or unconnected, that rule now just prohibits that from happening in future. Oh, yes, you have to. On the other hand, you will pay, your capital gains will be on that cost, yes. SARS does not lose. SARS always gains, yes. They cannot just leave it because people are going to constantly abuse that section. If it's abused once, it can be abused many times. And trust me, people pay big money to get that advice. How do I reduce my tax liability? All right, are you guys comfortable with this? This was about 4 or 5 marks, 4 marks, I think. All right, and then we have the disposal of our asset. Disposal of our asset, selling price limited to the cost. Selling price of our asset is equal to the market value, which is 598,000. Multiply this by 100 over 115 to get a selling price. So what's the selling price there? 520. Guys, comfortable with this? So my selling price, 520,000 Rand. The cost price of my asset is 480,000 Rand, which is equal to the market value. Multiply this by 100 over 11 what? Is it 4 or 5? 115. Plus, included there will be any cost to bring it to its present condition and location. Add to that 7,600, and that will be the cost of your asset. Excluding, okay, times 100 over 115. Okay, so that cost is equal to 424. Are you guys comfortable with this? So 424, selling price 520, cost 424, less tax value. Tax value of this asset is equal to the cost of your asset, 424, all right, prior year allowances, current year allowances. Prior year allowances, the year end of this company is September. So September year end, this was purchased in October. So no prior year allowances, only current year allowances. So if it's only current year allowances, 40% times 424000, nothing prior year, and that means that my tax value is 424000 times what? 60%. Does this make sense? So that goes into your current year as your wear and tear. 424 minus current year allowances gives you your tax value. So we use here 424. So allowances at 40%, 1,69600. Can anyone anticipate something here? Recoupment is equal to what? Anytime your selling price exceeds your cost, your recoupment is always equal to your allowances. So 424 minus 1,69600 gives us that tax value. That number minus that gives us that number. However, we need to see, do we have a replacement asset? If we have a replacement asset, 169,600, multiply that by the 20%, and that's added into our taxable income, if that's our replacement asset. Defer the recoupment or capital gain over the life of your replacement asset. Okay, so they didn't indicate in the question. If they didn't indicate in the question, I'll tax 100%. If they indicated, or if you assumed otherwise, you'll include at 20%. So they need to be more specific in the question. And the reason I'm doing this is so that I just remind you in future if that happens. Okay, so remember this was acid machine B. Machine B cost 300,000, market value 415. We ended up using 300 times 20% because that was the lower of the two. Right? This here is disposal of machine A that we're dealing with. All right, any questions so far? All right. Okay. Proceeds equal to your selling price minus recoupment. Selling price is equal to 520 minus your recoupment 169,600. All right, and then you have your base cost. Base cost is equal to the cost of your asset less allowances. Cost of your asset 424 minus allowances of 169,600, and that gives us whatever that was. All right, and then you calculate your capital gain. Once you've calculated your capital gain, do not forget, you'll go to the bottom of that calculation, include that as asset number 1. Asset number 2, aggregate gains minus prior year losses, multiply that by 80%, and that goes into your taxable income calculation. Okay, guys, these formulas need to be in your brain. Okay, so how do we calculate our recoupment? Selling price limited to the cost. Selling price 520, cost 424, less your tax value, right? Tax value is the cost of your asset, less prior year allowances, less your current year allowances. Okay, that gives you a recoupment. If you have a replacement asset, defer it over the life of your replacement asset. Proceeds, selling price minus recoupment, 520 minus 169 gave us our proceeds, base cost, and our capital gain. Easy marks here. Easy mark there. Right? If you're using paragraph 66 to defer your gain again, an easy mark there. Does this make sense, guys? We have done a few disposal questions. Okay. All right, so this asset was donated, right? So obviously there's going to be what? Donations, tax implications. So therefore you'll take the market value of that donation, 520. It's not a casual donation, so therefore multiply that by 20%, and that will be your donations tax implications. All right, looking at the person that receives that asset. They receive a manufacturing asset secondhand. Can they use Section 12C? Why not? No cost. So therefore, they'll only use Section 11E. Section 11E, you go back and look at what the note says. They'll be allowed to write it off over 6 years. And then you write it over the remaining. Okay, so donations tax. Yes, you are right. That's a group of companies. Was it a group of companies? Okay, if it was a group of companies, sorry guys, there is a specific exemption. All right, any questions on this one? Let's move on to the next one. Can you guys see why it can be 14 marks there? Quite a few things to write here. But guys, it's up to you to go and practice, because I have done a lot of questions from here, right? You listening to those questions does not mean that you understand what I'll say. So you have to go and redo all the questions that I did. And again, please do not regurgitate the UNISA solution if you don't understand what the UNISA solution says. Sometimes there's an error. Sometimes there's no error. Just say. Cool. All right, and then this one here, they purchased a new motor vehicle as defined, right? Motor vehicle is always inclusive of VAT. You cannot claim the VAT. So therefore, you'll take the cost of that vehicle, 437,000, divide that by the number of years that are allowed, multiply that by N over 12, and that's the wear and tear on your asset. This asset was immediately brought into use by the company's managing director. What are you thinking there? Fringe benefit, right? So why from a fringe benefit perspective? Debit, salaries, do you guys remember this? Credit what? Output tax. We calculate this from a VAT perspective. So we first calculate the output tax, and that output tax is then allowed as a salaries deduction. Because in your VAT return, you will have an output tax, and in your taxable income calculation, you will have a salaries deduction. So I use my VAT rules to calculate that fringe benefit. Remember, output tax, you will physically pay to SARS that output tax. But why did you incur that output tax? You incurred it as a fringe benefit. What's a fringe benefit? Expenditure actually incurred in the year of assessment in the production of income. You physically pay this, guys, that output tax, you physically pay it. But you can claim it as a general deduction. Okay, so how do you do that calculation? Cost less VAT, multiply that by 0.3% or what? 6%, all that multiplied by 15 over 115, all that multiplied by the number of months. Okay, so in this question here, the cost is equal to 437 times 100 over 115 times point, is it a motor vehicle as defined? Yes. Times 15 over 115 times the number of months. Receive this on July, 1st of July 2019. Year end is September, July, August, and September. Multiply that by 3, and that's your salaries deduction. The other side of this entry, you physically pay output tax to SARS. Okay, and how many people identified it was a fringe benefit? Very few people identified that. All right? Okay. So here there's an interaction between test 1 and test 4. So my assumption is they cannot ask you whether it's a fringe benefit or not. Motor vehicle, that we specifically teach you, right? But the other ones, I didn't. Actually, I did, because I only say there are 4 that will have a fringe benefit implications. 1, motor vehicle. 2, given an asset. 3 is forgiven debt, and 4 was something else. The rest do not have fringe benefit implications. Let's think about why it does not have a fringe benefit implication. It is residential accommodation, which is what? But again, once you get to your test 4, then you'll start seeing that picture holistically. Cool. Any questions? All right, and then we've got the last 2 questions, part B and part C. Am I done this side? Yep. All right, part B and part C. Guys, can you see? It really was 32 marks. All you have to do is write down everything. Do not just go for the calculation. Explain why you're doing that calculation. Okay, so let's assume they did not donate this asset, right, but could not afford a new machine. So therefore, they concluded an agreement with a non-connected third-party bank, right, where this company buys the new machine from the bank at a total cost of 500,000, excluding that. So my cost is equal to how much? 500,000. Guys, comfortable with this? Then sold this to another company. What are you guys thinking of here? Then in turn, leased the machine. Sale and lease back. So who's the original owner of the asset? Right? Bricks for All is my A here. Bricks for All then sells this asset to Randco. B in this transaction, who in this transaction will end up becoming the what? Lessor, right? The lessor then sells that asset back to, leases that asset to this guys. So number 1, there's a sale. Number 2, there's a lease. So this becomes the lessor, and that becomes the lease. Right. Fortunately, in the required, they opted out of asking this as a sale and leaseback, and they only asked what happens thereafter. Right? So after the 3 years, for a period of 36 months, Bricks will then acquire the asset at the end of the lease for 115,000 rand. So what is this? Abandoned lease. So they opted out of asking this as a sale and lease back, and they just asked what happens in the case of an abandoned lease. So market value is equal to 115,000 149,500, but I know it's including VAT. So how much is that? 149 times 100 over 115. 130. Okay, and you purchase it. Purchase price is equal to how much? 115. Multiply that by 100 over 115. That's therefore equal to how much? So it was purchased for less than the market value. Does this make sense? It's abandoned lease that was purchased for less than the market value. So therefore, there will be a recoupment into taxable income of how much? 30,000 Rand. So recouped into taxable income is 30,000 Rand. 100, 130 minus 100,000. Guys, go to page 34. You'll see exactly what I've written here. Step by step on page number 34. Is it 34, 35, 33? Guys, look at this. Asset purchased for a residual amount. Did we not purchase the asset for a residual amount? Take your market value less your repayments, and that's your section 85B. Recoupment. Is that not correct? Right? After I've done this, I now own an asset worth how much? How much is my asset? It's 130. Because I'm going to go for the market value when I'm looking at section what? 11E. I cannot use section 12C. Why can I not use section 12C? I'm bringing it back for the second time into use. I used it before, I'm using it again. So I cannot use section 12C. I used it before as a lease. Now I'm using it as the owner of the asset. So I cannot use section 12C. I use section 11E. Section 11E, value divided by the rate times N over 12. Value 130,000 Rand. That's the value of your asset, 130,000 Rand. Right, divide that by the rate. Are we given any rate here? What's the useful life of this asset? Actually, I think the useful life of the asset is given in the required. Okay, so they'll give you the useful life in the required, multiply that by rate, multiply that by N over 12, and that's your depreciation. If you're not given a rate as well, just do that. 130 divided by the rate times N over 12. Just to show I know what I'm doing. Don't panic in an exam, guys. Write down what you know. Okay, and then the other part of this required was deal with the VAT implications. Deal with the VAT implications of that transaction. So in dealing with the VAT implications of the transaction, number one, I entered into a lease agreement 3 years ago. What did I do from a VAT perspective? What did I do from a VAT perspective? Claim on day one the full VAT. All right, and then what happens when I buy this asset for 100,000 Rand? What happens when you buy the asset for 100,000 Rand? Will the seller charge me VAT? The seller charges me VAT, whatever VAT I pay, I will claim. Okay, any other questions here? Okay, let me go back and look at that sale and leaseback. Can I conceptually look at that sale and leaseback? I'm not going to do numbers. Just look at it conceptually. Guys, comfortable with that? Okay, so From a sale and leaseback perspective, if I'm looking at bricks for all, right? If I'm looking at bricks for all, these are my implications. Number one, I have entered into a sale agreement. What's a sale agreement going to result in? Disposal. So anytime I have a disposal, I will do this. Selling price limited to what? Less tax value. Am I right? The cost of my asset was equal to how much? 500,000 excluding VAT minus how much I depreciated in that period. Selling price of this asset is 690,000 rand. Sold it for that amount, right? So selling price 690,000 times 100 over 115. That will be my selling price. So selling price limited to the cost of your asset. So what can you already see here? Number one, I will have a what? CGT. What's 690 times 100 over 115? 600. Okay. So that's 600. That's 500. My anticipation is I will have a capital gain of how much? 100,000. The asset is appreciated from cost to selling price. Appreciated by 100,000, but I'll do the calc for you. Don't worry. So 500 minus my tax value. I purchased this asset on the 1st of June. I sold this asset on the 1st of July. Did I use the asset? Okay, so they needed to tell us whether they used the asset or not. Let's assume they used the asset. I'm assuming they used the asset, right? Even if they use the asset for 1 month, this is what they will do. Because Section 12C is not apportioned. Do you guys remember that? Right? 40% of 500,000 gives you how much? 200. So therefore my tax value is how much? Who can anticipate what my recoupment is? 200. So recoupment 200. Selling price equals to, proceeds equal to my selling price minus recoupment. Selling price 600, recoupment 200. Therefore my proceeds equal to 400. Base cost equal to the cost of my asset 500 minus allowances 200, which gives me how much? 300. Capital gain as anticipated is how much? 100,000. So therefore, these are the implications for bricks for all. Number one, they have a recoupment of 200,000. Recoupment. Number two, they have a capital gain of how much? 100. Multiply that by 80%. What goes into your taxable income? 80,000. Guys comfortable with that? And they also have allowances. How much are their allowances? 200K. Guys comfortable with this? The second implication here is that they're now paying a rental amount. So therefore they will have a rental what? Deduction. So you'll take your rental amount, multiply that by the number of months, and that's your rental deduction. Does this make sense? Okay. And then we go and look at the lessor. Everyone comfortable with the lessee? Lessee sells his asset, gets a recoupment, gets a capital gain, gets allowances. Cool? Now let's look at the lessor. The lessor, number one, is receiving what? Rental income. So you'll take your rental income times the number of months. That goes into your taxable income calculation. Make sense? Number 2, this guy now owns the asset. Am I right? This guy now owns the asset. If you own the asset, what can you claim? Wear and tear. So, if you can claim wear and tear, what section are you looking at? 11E or 12C? It's a manufacturing asset. 12C. But what's the problem with 12C? Only new or unused. This asset has already been used by our lessee, so therefore I cannot claim section 12C. If I cannot claim section 12C, what's the next thing that I'm going to do? Claim section 11E. What do I claim section 11E on? Right? This is what we claim it on. Page 33 in your handwritten notes. Cost of your asset to A. How much did A buy this asset for? How much did A buy the asset for? 500,000. That's cost for A. So 500,000 plus, let's just look at that. So it's 500 less your deductions. What deductions did A make or claim? 200,000 in allowances plus any recoupment, 200,000 plus any capital gain, which is 80,000. So the maximum that A can deduct, that the lessor can deduct on is how much? 580,000 Rand. How much was this asset sold to Randco? How much was this asset sold to Randco for? 600,000. So can you see, even though they paid 600,000 Rand, that 600,000 Rand will be limited to 580,000 Rand. Take that 580,000 Rand, divide that by rate, multiply that by N over 12, and that's your allowance. And that will be your allowance. Any questions, guys? Yep. It's a practical issue that I cannot solve. Yep. Yep. The VAT, yes. I know, because I'm not given enough information. Yeah, I'm just trying to get you to understand the conceptual side. You are correct. I need to remove the VAT, yes. I agree. And again, that's why I said I'm doing it from a conceptual perspective. Yes, so you can go and do that. Yes. Yeah. Okay. Any questions? Yep. Base cost of your asset. Two. Okay, remember donations tax is a totally separate tax. Okay, so that doesn't go to your taxable income. You pay that separately. It's a separate tax, donations tax. Okay, it's a long discussion. Can we put it offline? Because I actually did teach on that specifically a few months ago. Cool. All right, any questions, guys, before Rolene kills me? Any questions? Okay, so I will record 4861 test. Where should I start? Remember, your lessor charges VAT, right? And whatever VAT they charge on the invoice that they pay to SARS. For what they charge. From a lessor's perspective, they will charge VAT on a monthly basis. Okay, yep. One more question, guys. Can you give me just 2 more minutes? Yes. Yeah. But the calculation comes from 23D. The bottom part of that calculation comes from 23D. All right. Okay, guys, so this brings us to the end of test 2. Okay, can I just have 2 minutes? So, end of test 2. Obviously, I need to address you guys. So that's why I'm taking my time to address you. So, you know that I'm not taking you for test 3. Okay, guys, let me address you. Okay, because you're already talking to me here. Okay, so guys, from day 1, I already told you that I'm not taking you for test 3. All right, if you guys do remember. All right. Okay, so remember what happened 2 weeks ago? Why I cut the lecture short? I was starting to say a whole lot of nonsense. All right. Okay. And the reason for that, guys, is pure fatigue. I get tired. Okay. So last year, I taught from day 1 to literally the last day, walking in from tax 1501 into a tax 4862 or 4861 class. So how many of you know that that's not possible? Like to teach from tax 1501, 2601, 3701, 3702, 4861, 4862, and you're just one person. So I ended up in a similar situation where I was saying a whole lot of nonsense. Okay. And I'm saying nonsense. My mind is not processing things correctly. You remember from last week, eh? Okay. So I spoke to I spoke to the powers that be, and they decided they'll give me test 3 off. Is that cool? So last week, what happened was supposed to see you for 8 hours, but I was sick. So I had a choice to make. Either I cancel this class, which was last week, either I cancel this class or I cancel undergrad. So I couldn't cancel both this class and undergrad. Make sense? So I chose to cancel this class. But can you see, that's not fair to you. Because last week, I was supposed to go through this and then go through the art class. You guys remember that? So you guys have lost on the 4 hours because one person has to do all that work. So if I'm sick, I have to choose. I'll still work, but I have to work less. So does that make sense? Okay. So Esther, I taught you from tax what? Tax 1541. Cassidy taught you from tax 2601. And guys, I'm still doing the same. Tax 1541, 2601, 3701, 3702. So yes, I'm taking a break from test 3. Okay? I need to recharge my batteries. Okay. Yes. Yes. That much I agree with you. To be very honest with you, yes, yes. Guys, using logic. So, number one, I was being pulled three ways. So, there's undergrad, postgrad, and there's something else that I'm doing. Okay? So, I'm being pulled three ways. So, I'm actually at a crossroad. So, I want to be honest with you. So, I'm actually at a crossroad where it's not possible to be pulled three ways. Yes, I'm recording. This is for the benefit of the online as well. Okay? Right? So, I'm pulled three ways. Right? I'm not coping. Right? I am taking a break for test three, but if I come back, it will be the same thing again. Where I'm pulled three ways. Undergrad, postgrad, and something else. Okay. So, I may make a decision not to come back after test three. I may make a decision not to come back, but this is obviously what I'm thinking about, and I'm telling you guys honestly. Okay, I may not come back after test three, but a lot of things that I need to also consider. Number one, I've rooted my life, it's now in Greenstone. So my house, everything is now in Greenstone. So before I make any other decision, I need to consider that as well. All right, and the other thing is, I've taught you guys from Esther, for example, for years, Milan, years, right? So again, there's the emotional side of things. So I haven't made a decision, but I will make a decision soon. So just letting you know. Cool. All right. Cheers, guys.